We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Mike McGlone, macro strategist at Bloomberg Intelligence. Thanks for joining me today, Mike.
Thanks for having me, Tom. I'm looking forward to our discussion.
Absolutely, me too. You know, I feel really privileged getting to have these types of conversations and sit down and really dig into researching every one of my guests, what they have to say. And this discussion isn't going to be any different here. But I wanted to kind of start from a very, let's say, step back macro perspective. With many indicators pointing towards a recession within 6 months, I think that's a good place to kind of jump off here and discuss a bit about the indicators that are signaling recession and what you foresee the odds of a soft landing or let's say the severity of the recession ahead.
I think that's a great start. It's where everything is going. And the concept of a soft landing, I think, is an oxymoron given the foundation of what got us here. We've just coming near the end of the most significant global rate hike cycle in history, bar none. Fed has never come from 0 to 5.25 this fast. And we're also on the back of the biggest pump in liquidity in the history of mankind, bar none, that's dumping fast. All the lessons of history and markets say that when liquidity pumps and markets rally and liquidity dumps, markets go down and typically very hard. I mean, that was kind of why I'm kind of going back to 1930s, so a lot of my analysis. So the key leading indicators for recession, first you have to start with the Fed. And never forget where you're from. And then the inverted yield curve, the 2-year note yield right now, the 2-year note is like 5.14. The Fed's upper bound is 5.5, and the 30-year bond is 4.7. That's an inverted curve. That means in the future, the market's expecting somewhat deflationary recession. And then you have to add to what happened with this got us here is we had this pandemic, and 3 years ago, we all thought we were going to die. Now, there's a good reason for liquidity. So the governments pumped the most liquidity in the history of mankind. If you look at M2 money supply, it pumped up 40%, and now it's negative on an annual basis. And then also last year, right as the Fed started tightening, we had this war. Russia invades Ukraine, and with questionable unlimited friendship with China. Starts a Cold War, hot war, all the above. But it also came at the time that the U.S. stock market, relative to GDP, was the most stretched since 1936. You got to go back about 90 years. So what I think we're doing right now is going past, and what that did is all ended the longest period in history of zero interest rates, unprecedented. That's over. That's done. So I like to look forward to. I say, here's what's different. Rates are not low anymore. Your average investor right now can lock in a U.S. government 2-year note and guarantee and get over 10% in the next 2 years. That's a bit of pressure for risk assets. Most notably, it's a pressure factor for gold at the moment. But the stock market dividend yield is less than 2. And the spread now between the stock market dividend yield and the 2-year note is the widest since 2001. So to me, what we're doing right now is early days of the biggest reversion of the biggest pump in equities since the 1920s, that peak, and going back to a simple reversion towards what might be considered fair value. We can get into that, but it's global and it's macro. We have all the indications that Europe is clearly in recession. I can dig into that. We're seeing a significant deteriorating growth in China. And for US, it's just a matter of time. But this recession, here's the key thing I'll end with and we'll tilt, is it's classic human nature too, Tom. So at the beginning of last year, everybody was calling for a recession in the US. Me too, wrong, early included. The conference board, leading indicators, Bloomberg Economics. And then it tilted back to, no, it's not going to happen, and it's a soft landing. And now we're tilting back to the reality of what's happened is the Fed has hiked rates another 100 basis points this year on the back of the massive fiscal stimulus, on the back of the tilt away from recession, which means it's probably going to be worse now.
So exactly as you're saying there are a big bunch of pieces to kind of break apart there. Maybe let's start with the economic situation in China and how that plays into the picture here as well. You know, much was expected from them to, let's say, contribute to demand for oil and commodities when their zero COVID policies were lifted. And that really didn't seem to have much of an effect based on what was projected. So what are the main issues that China is struggling with right now?
It's a combination, in my view, of the book Atlas Shrugged by Ayn Rand, which was a good example of the failings of autocratic leaders. Mm-hmm. I read that about a couple decades ago. I probably need to refresh myself. Peak Soviet Union and peak Japan about 3 decades ago. It's all combined into one in China right now. One leader started with, President Xi started with banning Winnie the Pooh in 2015. I like to go to a little humor there because he did. And we're like, okay, we know there's a problem there. Complete autocratic leadership, and the failings of what usually happens that way. So, and also then the support of the unlimited friendship of Russia, which basically pissed off their best customers, which is Europe and the US. So, to me, then you also add to that the kind of exponential economic growth that you had. China has jumped up to about almost a $20 trillion economy. The U.S. is 27, almost 30 trillion from 4 just about 10 years ago. Remember, Japanese economy peaked around 1980, around a 4 trillion economy, has been that place since. So too far, too fast, overbuilding, property crisis, probably worse than Japan was when it peaked in 89. It's probably as bad as U.S. was 2006 at the peak. And what's going to save it? Well, exports aren't happening. The U.S. is now importing more and more from Mexico than from China. It's a complete GMTFO situation, all started partly because of the leadership of President Xi. It's going backwards in time. There's a great backwards in that capitalist bent, basically when the Nixon went over in 72 and tilted the kind of a peasant type economy towards more of a capitalist city dwelling type economy. Now they're tilting back. There's a great book called The Great Rupture by Victor Shivitz, and had a whole chapter there on China, how they tilted back in the 18th century from the Ming Dynasty to an inward slight country. And they're doing the exact same thing now. So just a little mean reversion to that economic miracle is what I'm expecting. And it's normal. It's always happened. And there's some significant catalysts for it to happen. Like I said, their export base is basically just been reverted completely. It's just get me as much out as I can of China. Their 2 customers are going into severe recession. That's Europe and US, and plus the nearshoring, reshoring, get me out of China for good reason. I mean, they made themselves an enemy. And the main thing, and then of course what's happened with overbuilding. I mean, I was there 10 years ago. I could see it happening. I just been waiting for it to happen, and now it's happening. The key question is what stops it. And right now, there's no signs of it. Yeah, sure, you have to expect some form of fiscal and monetary stimulus, but look what's happened to currency. It's collapsing. The spread between the U.S. 2-year note, which is right about 5.14%, and the Chinese 2-year note is the widest. It's about 300 basis points. It's widest since 2006. But back then, yuan was around 8 to the dollar. Right now, it's creeping up around 7 and change to the dollar. It's probably going to go to 8. It's just going to decline. It's just an overwhelming force of dollar strength on the global economy right now. It's a wrecking ball. And China is the number 2 economy. Export markets is way overdue for just a little bit of normal reversion in a rapidly expanding emerging market that reverts. And also, what's the key thing about China? Major gold bias. We've seen that in gold premiums in China lately. It's just, please give me some safe quality, because their number 1 investment source, property market, is collapsing. And that's where it's tilts part of my gold bullishness. But overall, the key situation is just normal reversion there. And the key question is what stops this Cold War, what stops this hot war, which China is right in the middle of.
So, Mike, when we think about, the idea that they are facing a normal reversion here, do you think that they can pull out, some tricks out of the bag to be able to stop that and ease the pain from a real hard recession there?
Oh, sure. They will. They have. They are. It's fully expected. Exactly what they're going to do, the fiscal, they have to lay low. And they put massive fiscal stimulus in 2008 when the U.S. had its problem. That's kind of overdue. Their indebted regions are quite over indebted. They can only do so much with the currency. It's collapsing. Mm-hmm. The rumors are they're selling treasuries to support their currency, and that's part of the reason yields are go up. No, that's harder to define. But I like to point out the facts of the trends, and that is the spread between the things you can't I mean, they can fake all the data they want. I mean, that's the
Mhm.
key thing. Is an inside scoop. As a Bloomberg journalist, I have to be very careful writing about China. One of my colleagues was technically detained for a year for writing on something unfriendly about China. So there's no free discourse, no openness about what's happening, and that usually means there's a sign of something wrong.
Mhm.
So that's the macro, and then so the micro. Really, what's happening is just look at their currency; it's melting every day. They're cutting their interest rates, while the rest of the worlds are hiking rates, and you have to expect any type of stimulus possible, but I don't know exactly what it's going to. It's just something you're going to expect. It's something that it's going to make markets bounce, and I think the true hot money in the world is going to sell into those bounces.
Mhm. So the other part of what you mentioned there, that they're really kind of in the middle of the war there. Do you see China really starting to escalate, let's say in Taiwan, or being more involved with Russia, or does that kind of go against the incentives that they have laid out in front of them to be able to still, try to keep the customers that they have and continue to export the goods that they are making?
So that's one of the key things is I be careful. I have to be careful with speculating about too much. But one thing we need to completely expect from very extremely autocratic leaders is the self factor, someone else's fault. And that's what Xi has been doing clearly since the Trump really started cracking down on intellectual property and things in 2000, I think it was 18, is when he started blaming everything on the U.S. Now, your average Chinese person, I think, would not mind watching a U.S. movie and drinking a soda pop and not really care. Just let me be part of this global economy. And, you guys make some great jeans and cigarettes and things. But this is the key thing, is that the tilt from the leadership is completely internal and autocratic. So his key lessons of Taiwan is, after the Russia's failed invasion of Ukraine was supposed to last a week and be done with this, I think the probability of China orchestrating an amphibious landing and taking over Taiwan is declined. But to me, that doesn't matter so much. That's more for the macro that I don't see it tilting that way. But what's happening with their South China Sea and their inklings to take over a lot of international territorial water is getting a bit scary. But I think this is also a key thing that's so bullish for the U.S. and the Dow. The rest of the free world, which the U.S. is somewhat responsible for by providing security, particularly on the open seas, has a choice to make right now. Do you want to go to the Chinese-Russian model? Or do you want to go to the U.S. model? I mean, they speak French in France, they speak German in Germany. They don't play baseball, and there's a reason for that. They do play baseball in Japan, but we're good. I'm just kind of kidding around, but we're good allies for a reason. Because the U.S. has one major bent in the world. It's not perfect, but it's just we want to do business, and that's just the way it's always been. China, a little different views, but that's the key thing. That's one of the significant strengths of the dollar. Do you want to go to the yuan or the euro or the ruble? I don't think so. And it's part of the problem. It's the dollar, unstoppable dollar, which is very bearish for commodities, bearish for inflation. It's kind of a pressure factor in dollar-based gold. But I think that tilt is only going to increase the value of the U.S. system, the dollar, military, even though we're still heading towards a recession. Although recession here means a depression there.
Interesting. I was going to say, to contrast, let's say, that growth story that we have seen out of China in the last decade, you were mentioning Europe's recessionary woes that are kind of overhanging it as well. So if you could explain us the situation, or let's say the difference there versus China.
Europe, you said. Okay.
Mm-hmm.
Let's look at the facts of Europe. ECB just tightened about a week ago. They're still tightening, yet PMIs, purchasing managers indices, and services are negative, below 50. Retail sales, on a real basis, less inflation, are negative. So Europe is in a recession based on those metrics, and they're still tightening. That's what's changed. That's why my basic outlook for one of the most significant resets of a lifetime, which I started about a year ago, is gaining traction. Typically, when you get to this point in the economic cycle, when PMIs, retail sales are negative, showing clear economic contraction, recession, you start cutting rates, but they're not. They're still hiking. That's the lessons of too much liquidity, zero and negative interest rates can only last so long, massive pumps in inflation that resulted, and now we're in the dump phase. The lessons from the book Boom and bust. Quinn was one of the authors. That's what it always happens, and it's happening now in real time. It's just these things just don't happen overnight. So that's the way I see Europe right now. Let's look at Germany. I mean, it's basically in a recession all year, and are they exporting much to China anymore? What's happening with Europe recently is the Build Your Dreams (BYD), the electronic EV exporter out of China, is not dumping, but they're trying to sell very cheap, cost-effective EVs in Europe. It's not playing out very well, but that's the trend. It's from another book, the Price of Tomorrow by Jeff Booth, pointing out the deflationary forces of rapidly advancing technology. I drive an electric vehicle, but China is the leader there. About 40% of their total vehicle sales now are EVs, and they're trying to push it onto Europe. And that's a major shift from a country, a continent, particularly Germany. It's used to making and exporting internal combustion engines that have 5,000 moving parts, and you can now do that in an EV with 500 moving parts.
Yeah, and I think we have yet to see how, I think they got lucky last year with a very mild winter. And I think it'll be, interesting to see, to be able to watch what happens this year with energy prices and how that affects them going forward as well.
Well, I appreciate that mention. And I do like to point that out, that global warming happens in the winter too. And it was part of the reason I was very bearish natural gas. Now, one of the most important things for someone like me to do is admit when you're wrong, stop yourself out, move on and see what it means. That was one I got right, but I'll just point out the facts of what happened last year. It was a mild winter, but what's the trend in winters? What's the trend in global warming? Yes, winters are warmer than normal. That's probably not going to change. Yes, we might get one of those 10. We get a really cold winter, but stockpiles are completely full. They're completely prepared for it. And if it does happen, there's other things. Don't underestimate humans in necessity, particularly when you've had a few years to plan. So that I'm not worried about. And it's part of the reason I like to point out of the bottom line deflationary forces some people are missing in this country. Net exporter of energy, net exporter of agriculture. The benchmark measure in this country for heat, electricity, and fertilizer is our U.S. natural gas contract. It dropped 80% from last year's high, around 10, dropped to 2. And it's traded right now, still hovering around 2 and change. That's million BTUs, which was first traded in 1990. Imagine we said that about the stock market. Guess what's not too much farther, still below a level from 1990, the Nikkei. So that's a key thing to remember about what happened in Europe. What's going to happen this summer is another winter, probably going to be mild than normal. What's the trend in global warming? But I need to point that out when people last year were so worried about it. But that's how human nature works, is it gives you these great trading opportunities, but oftentimes in good investment opportunities. So benchmark measure of heat, electricity, and fertilizer in this country. And how were we able to do that, become a net exporter? Is just harnessing that rapidly advancing technology. It's not perfect, but better than most other countries, particularly Europe, who became too dependent on Russia. But what's happening now? Huge shift to EVs, huge shift to alts. And now it's not just what happens with necessity and invention is kicking in.
Mm-hmm. Mike, kind of going back to this idea of, let's say, choosing one model or the other, whether that's the China-Russia model or the somewhat Western, let's say, US model. We saw the BRICS summit that was much rumored that there was a gold-backed trading currency that was going to be introduced at the summit there last year. Yet that wasn't an outcome of the meeting. So how do you see the BRICS alliance affecting the dollar going forward here?
Oh, I love what Jim O'Neill, who coined the term, said. It's silly, actually. I don't think he used the word silly, but it's great they're trying to get together. But it honestly, Tom, it shows the strength of the dollar. They're trying to come up with an alternative. And let's tilt over to one of the most significant technologies on the planet in terms of currencies and the last rapidly advancing technology of the last 15 years, cryptos. Their base layer is the dollar. They didn't have to go for the dollar, but they chose crypto dollars, stable coins. It chose the dollar because it's the best currency on the planet. It's becoming more so every day, particularly with what's happening in China. Don't know what's going on with their balance, particularly what's happening in Russia. And BRICS are trying to catch up. Remember, Brazil is a melting currency. India is a melting currency. China is still melting. I mean, there's a melting currencies versus the dollars. And only Brazil recently cut, but they've done well in the last few years. I have to admit, they hiked early and cut back, and their exports to soybeans are massive. Why? Because prices, they're doing some things right there, but India's probably going to do very well. But again, that's another melting currency. But they might be able to try to go gold back. That's the only alternative to for fiat currencies, bar none, on this global scale. Very imperfect. U.S. dollars at 10. Everything else is maximum. Maybe the euro's at 2. Everything else is below that. And then there's this shorter term issue. Then the U.S. dollars, you can clunk down U.S. dollars, and the U.S. government will pay you 5.1% in 2 years, guaranteed. That is a giant sucking sound of risk asset money going that way, and no other country can keep up with the seriously deep pockets of U.S. treasuries. And the system's imperfect. Yes, we're going to have a shutdown, but we have open discourse. We beat ourselves up and we figure it out. You don't have that in China. So I'm not worried about that. I love years ago being in Europe and having alcohol, I should say refreshments with Swiss colleagues, pointing out the benefit of the US dollar. And by the way, thank you, US, for not letting those Russian tanks come down.
Mm-hmm. So, Mike, I've read that you think that the Fed is leaning towards hiking rates at its November meeting, yet that risk may gradually then suddenly become elevated. So why would risk suddenly elevate, considering that the Fed raising by another 250 basis points is equal, let's say, with their least aggressive hikes in this cycle?
So they're not going to hike again. McGlone's view, they're done. Fed fund futures, which I just typed on the terminal, there's a function called WIRP, shows the rate right now, effective rate's 5.33, and it shows the market expects the peak in January around 5.46. So it means the market's still tilting towards they might hike a little bit. It's not a full hike, but it's still showing the probability is that they might 25% still hike. That's not going to happen. And the way it usually happens is you go up on the escalator, down on the elevator, and there's a number one factor to keep those hikes out of the market. And that's the number one bridge we have, the first bridge we have to cross, and that's the stock market or risk assets going down. And it's just getting started, I think. They went up too much. I think S&P 500 might go back to unchanged in the year. You need that to go down, or the Fed's going to stay vigilant. It's just the way it works. And that's a key lesson I like to point out recently is I went back to 1950, and virtually every single time the stock market's been down 20%, S&P 500 on a 12-month basis, the Fed has always started easing, always, except now. Why? Because we've reached the end of the rope. The Fed knows it, and investors are starting to figure it out that we've had this period of zero interest rates that's pumped up this equity market to a very expensive level versus GDP. I explain that in a second. The most expensive since 1936. And now we're tilting towards higher rates, which means stocks should get cheaper relative to GDP and relative to interest rates. It's just a normal cycle, but it's just starting to happen now. And the Fed knows this is their chance, I think, to cut that umbilical cord when the market looks over. And every time it goes down, the Fed saves them. They're done with it. Everybody, I think the market's done with it, but most investors haven't figured it out yet. And that's why I point out is sometimes life is very simple. You click off the TV of CNBC, there's that government tuning note, 5.13%. Say, thank you very much. I'll see you in 2 years and I'll take my 10%. And then worry about where things are then.
Mm-hmm. Yeah, that's
that's where I think we are now.
Mm-hmm. That's an interesting way to put it. And, I've heard you speak about the previous market bottoms and, combining that with many indicators pointing to recession, interest rates above CPI, the Fed seems to be, as you put it, baited by the stock market to keep tightening, at least to this point. So are they only waiting for the market to make them reverse course here? Or, are they really trying to teach that market a lesson and break that Fed put?
I think it's all the above. They can't say it that way, but it's very simplistic. Their targets for inflation is 2%. That's global. That's not changing. And yet their measures of inflation, employment cost index, personal consumption expenditures are running 4%. It's not that complicated. Now they're falling, but they're very much lagging. And my job is to look ahead. And I fully expect those measures of virtually all inflation measures are going to go to negative. Point is already happened. PPI year over year, this low this year is minus 3.1%. Guess what the high was in 2008? 9.9. It was almost 10%. And the Fed started easing back then. So in 2007. So to me, that's the key point is they know it. They see the cycles. Inflation's above their target, yet unemployment's still very low, but everything's starting to tilt. And this is the way it usually works, Tom, is it's gradually and then suddenly. That's just the way markets are. So I think it's riskier. There's a high risk that the equity market's going to go down on the elevator. I hope not. But if it doesn't, it's just we're there. There's no way they're going to take out that hiking until something makes them. Time would be wonderful, but markets don't usually work that way. And then there's so many indicators of significant deflation already kicking. Like I mentioned, PPI went up the most in history. It goes back to 1948 and then dropped the most in history. It dropped from 18 to minus 3.1%. The low this year is deflationary. Now it's running around 2. Now it's bounced a little bit. But it's just a matter of time. Industrial metals, the Bloomberg Industrial Metals, one of the best global indications for demand pull economic growth. They're down 12% this year. Copper's down 12%. Nickel's down. All these things that really coincide with global cycles are down. And that's divergent weakness versus stock market. So what's the outlier here is the U.S. stock market. Also a key problem there is what's been driving this Dow wrecking ball, and the dollar's been unstoppable since basically 2011 or so, has been the U.S. stock market outperforming the world. That probably has to revert, or the dollar wrecking ball will remain that way. And again, you can get so much better yield in that dollar. So to me, that's all what's going to just be simple mean reverting. And the Fed is part of it. But the simple bottom line is we've just learned the lesson of too much liquidity and too much inflation. That Fed put is gone, and it's going to take something significant to bring it back.
Mm-hmm. So do you see a similar cyclical bounce to inflation that we saw in the 70s, where we had these, let's say, 3 cycles of higher highs and higher lows? Or are you going back to that?
No.
The model that you're saying that was like the Great Depression in the 30s.
So I think 1970s inflation comparisons are just basically silly. What produced inflation? One thing, what Milton Friedman warned us: money supply, the massive pump in liquidity in fiat currencies. I mean, U.S. money supply increased 40%. Virtually every asset increased 40%. It's not that complicated. That's going negative now. So 70s inflation took decades. And also remember, the boomers are in their prime spendings. What are boomers now? They're happy to take that tune out and say, thank you very much. I just had a great decade in the stock market. It's completely the opposite. I see us heading towards a severe deflationary forces akin to 1930. And we're all doing that right now. The big difference with what happened with the pump in liquidity in history in 1929, which is to me the best comparison to now, is the Fed started easing in 1924. That was the New York Fed, to the lowest rates in the world, and started hiking in 28 when they saw things getting excessive. Then they started easing as the stock market crashed. The Fed, ECB, and most central banks are still tightening. That's the key thing to remember, is liquidity is nowhere near yet we're starting to roll over. We've reached that point in the cycle. It's a 100-year cycle where the inflation and asset pumps are dumping and should continue. And it's just normal cycle. We had unprecedented period of zero interest rates, and they're no longer zero. So that's why I think the housing market's already starting to fall pretty hard. I mean, you look at existing home sales, they're falling at the same pace. Actually, at this, and right near the bottom of the trough in 2008 is where existing home sales are falling. New homes under construction, and they're the highest ever, which means that inventory coming back. You see that spread in the 30-year mortgage rate, and the 10-year note and the yield is the widest since 1983. So we're completely basically locking up the housing market. That's just part of it. The yield curve, I just look at this as slow motion, and the final thing that usually falls is the stock market, and it's just going to mean revert, and that's all. I mean, it seems complicated. Like 87 crash was a bit of mean reversion, but back then the stock market was pretty cheap versus GDP. The point I like to make is here's a simple measure. If you take U.S. GDP, you multiply by 100. That's been the S&P 500 cat and mouse game around that level since essentially 1928. So right now, U.S. GDP is around $27 trillion. So that's a 2,700 level in the stock market. It basically means that I think the S&P 500 is supposed to drop to around that level. Not a big deal in a normal recession. Now, Bloomberg economics model, 6 months as recession starts by the end of this year. The Conference Board leading indicator shows recession starting. Their record is 100 years, 100% accurate. So I'll stick with that. And the bottom line is we still see that tightening from the Fed. So this to me is the macro of just those mean reversions going to kind of back to just taking back levels that got excessive, but for a good reason. I mean, we had zero interest rates forever. Those days are over.
So, Mike, coming off of this, as you just mentioned, the zero interest rate, regime, and then combining that with the biggest pump in liquidity, as you mentioned earlier, does that set us up for an extremely, dramatic recession and or depression? Or what does this look like to you? What is ahead of us?
So about a year ago, Tom, I started calling it the greatest reset of our lifetimes, just based on the normal cycles in study. I think it's one thing I had done and is going back and revisiting many history books. I mentioned a few of them. I can dig into some other ones, but you have to go back and see what usually happens when you do this. So I think it's going to be the biggest reset of our lifetime. The thing is about the depression is it's not going to be that bad. We've learned that lesson. But here's the key difference versus every single dip we've had in the stock market for essentially the last 50 years is the Fed has told us they will not be providing liquidity. So this is what's different is the plateau, the base for let's look at the base for CPI is one of the number one factors for CPI is owner's equivalent rent. It's based on the average price of a home. Mm-hmm. So in the last 5 years, the average price of a home in this country has gone from around 200, maybe 6 years, 200 to 400. And now it's starting to tick lower. So that base for measuring for inflation is not from 200 now, it's from 400. And it's going lower, particularly as the market locks up, just like a normal cycle like it did from 2006 to the bottom in 2011 in the housing market. So that, to me, is the key thing to look forward to. But it's also a 100-year cycle. What got us here? Started with COVID. Unprecedented lockups, unprecedented money supply securities, unprecedented war. Okay, well, it's been 80 years. The former counterbalance to the Soviet Union, China, cozying up with the Soviet Union, well, former Soviet Union. And just the classic cycles that are all come into play. The key thing I like to ask myself is what stops it. Typically, Tom, at this stage, it takes pretty significant liquidity from the Fed. So just a simple example, the last two bottoms in the stock market, 2002 and 2009, were preceded by the Fed starting to ease almost 2 years before. They started easing at the start of 2001. They started easing at this September 2007. They're still tightening. That's the problem. So one bridge at a time. The stock market, I think, is going to make them go that way just by normal reversion. We have to get started on an easing cycle. And then maybe at some point we'll have a bottom in risk assets. And how we get through that next bridge, I don't know. But right now, the first bridge is, the first thing we have to do is this tightening that's still priced in to January, let's take that out first. Or they tighten, which is going to make it worse. So here's, I think, what really made it worse this year. It's this almost unprecedented fiscal stimulus, partly for the midterms and things. The quote I heard is it added up to $3 trillion with tax benefits to the economy. That's almost 10% of GDP. And what did that do? It boosted the market. Students didn't have to pay back their loans. They bought stuff. It made the stock market go back up. And what did it also do? The Fed raised another 100 basis points this year. Liquidity is worse now than it was, and it's still pointing negative. So key thing I watch is the Fed funds. I like to watch one key thing I watch is the Fed fund futures in 1 year. And on the terminal, it's FF13. It's the 13th contract. And that still shows rates going up. So the market has to start at least anticipate that liquidity coming before you can expect for markets to even think about bottoming. We're not even there. We're not even close. So that's how I look at this. It's just normal reversion. It's just getting started.
Mm-hmm. Mike, you mentioned, let's say, the drop in demand for copper resulting in that 14% drop in that metal this year. We've seen a surge in crude prices over the last 2 months. So how does crude oil play into affecting the slowdown? And does the demand drop during this recession have a substantial dampening effect on price?
Well, I'm glad you went there, Tom, because crude oil is a wrecking ball commodity. When it goes up a lot, it wrecks economies. Now, the recent pump, right now, we're talking on September 26th, it's up about 13% a year. Copper is down about 5% in the year. Industrial metals index are down 12% if you include all the industrial metals. I like to do that sometimes because copper can sometimes have supply issues with mines and things. But when crude oil goes up a lot, remember 2008, it peaked at 145. Remember when gas in the US went to $4? If there's one good way to really crush consumer sentiments, the stock market going down and unleaded gas going up. Bam, you're done. It's redoing that in a smaller pace and more of a bear market. The high was 130 last year. The high in 2008 was 145. That's an enduring bear market. The lows have been lowered since. So that recent spike has been kind of a supply thing. But then you have to look over what's been the key thing pressuring crude oil for the last 15 years or so. It's that paradigm shift in the U.S. going from the largest importer of crude oil on the planet to a net exporter and exporter of LNG and exporter of agriculture. How did we do that? Well, there's been demographic shifts, efficiency, but now it's all going EVs. If you include Canada, the surplus of U.S. liquid fuels and crude oil in U.S. and Canada is now about 6 million barrels a day. Put that in context. 2008 was a deficit of about 10, 11 million barrels a day. OPEC is becoming less significant. They're making itself redundant. They're cutting because like I say, they see what's happening. But that's bad for China, bad for Europe and most of the importing countries who need it, but not the U.S. It's actually good for U.S. producers. But let's tilt over to copper. Dr. Copper is one of the best indicators of it. Usually flows with economic activity. If it spikes, it doesn't mess it up like crude oil does. And by going down this year, part of the reason it's going down is because crude oil is going up. Because crude oil goes up a lot, it takes away from GDP. Copper's reflective of GDP. So I like to look, here's one thing I like to bring into you, and I'll end with this. You look at the dollar price of copper as we speak, it's $3.60, 64 cents a pound. It peaked around $5 last year, which was an all-time high. It's made higher highs and higher lows. It's more of a bull market, but it's correcting. I think it's going to go back to 3, which implies similar. If you overlay copper and the S&P 500, just divide by 1,000, it's been the same price since 2015. I think that's part of my indication that S&P 500 is going to 3,000. And if you take copper and you overlay it with the U.S. 10-year note yield, which right now is pretty high at 4.56, I think also the 10-year note yield is going to 3%. In a normal U.S. recession, which our Bloomberg economics team has at 100% starting probably by the end of this year. They've been early. You can say they're wrong. I've been early. You can say I've been wrong. But the key bottom line is what's happened since we started making these calls about a year ago is the Fed's hiked another 100 basis points.
Mm-hmm. Does gold tend to outshine copper and crude simply because of the demand conditions being dampened during these times of uncertainty?
Oh, yeah. Well, it's always the go-to. I mean, it's becoming the go-to in China, in India, and any place is a melting currency. And you can, gold has that cultural thing. But the key thing to remember, I think, about gold is it basically outshines virtually every commodity over time. Everyone. If you look at them over time, partly if you really have to store it. If you have to store crude oil, it's a toxic chemical. And the way you measure that is you can do futures. But I love overlaying and pointing out that trend. Almost all commodities. Now, it's maybe more closely correlated with copper, particularly versus the dollar, but it's a metal. I mean, you could drop it in the bottom of the ocean 1,000 years, it'll come back, and it's still there. Can't do that with any other commodity. Always forget that. And you never want to be long the price of a commodity you can grow in the long term. Mm-hmm. You want to be able to be a producer and sell that. Because why? You can grow petroleum in this country. 15% of our unleaded gas now comes from corn now, and that's going down. But the key thing about gold is right now is remember what it did in 2008? I was very long gold in treasuries because I was expecting that crash. That was one I got right. But way too early. It went from 1,000 to 700 before it went to 1,900. It goes down when people hit stops, which at the time we're talking is starting to happen. You sell what you can. But I think what's going to come out of this enduring deflationary recession, you have to get a pivot from the Fed. And just like it did from 2008 to 2011, I think gold's going to be one of the best performers. Now, it has been this year. It's still up 4%. Bloomberg Commodity Index is down 6%. Industrial metals are down 12%. That's a deflationary, recessionary leaning. But it's under pressure now, particularly also it's facing the Fed. You can get you don't get any yield from gold, but you can get 5.1% from U.S. government. To me, that's a giant sucking sound for all risk assets. And it's also this year, it's had to face the stock market. It's been very resilient. I mean, what's really pressured gold for a lot of the last 10 years is, okay, well, the stock market's been a better place to be. That's changed. But I think we're in a transition time now, Tom, depending on when we publish. But I think we're at that transition time is that everything is going down. Because the recession's starting, people are starting to believe it. The stock market's going down. You hit risk assets, gold's in there, but it should come out ahead. And I think most astute investors are probably more looking to buy gold and sell risk assets like stocks and copper.
Mm-hmm. You mentioned S&P at 3,000. Could we see the S&P to gold ratio reach 1-to-1, Mike?
That's why I think we're going. So one thing I enjoyed publishing recently, Tom, I don't know if I put it on LinkedIn or Twitter, but I will, is if you take the price of gold and in ounces and overlay the S&P 500. It's basically been a cat and mouse game since when the U.S. came off the gold standard in 1971. Gold gets cheap, gold gets expensive versus the S&P 500. Right now, it's basically, as you mentioned, half the price of the S&P 500. I think they're going to meet at 3,000. It's not complicated, but typically what happens is when you go into U.S. recessions, if gold is cheaper than the S&P 500, it does very well. The last two. If it's more expensive than the S&P 500, it doesn't do well. It's half the price right now, enough said. So that to me is, and it's not going to be easy, particularly as you start tilting towards these things, and particularly when people start hitting their stops and realizing, oh man, I'm overweight along the equity market. Everybody is. If you've been in it for the last 10 years, it just makes you overweight and underweight gold. So that's the key thing I always look at. It's sometimes it's so best to use the KISS method, and that is one thing I've published recently. I'll put it again on LinkedIn and Twitter is just take gold with the S&P 500. And typically, when it's this cheap, you probably better off long gold and short the S&P 500. When you go to recession, if you want to get a measure for the S&P 500, just measure with divide by GDP times 100 to get to the same level as the S&P 500. That's why I think we're both going. I think it all meets around 3,000.
Excellent. When you and I started speaking today, obviously you and I have never spoken before. And I said, I'd like to hear all your views, not necessarily bullish or bearish. Just because we have gold in our name doesn't mean I want that confirmation bias. How important is it to you, Mike, to really look at your convictions or your calls and try to figure out where you were wrong and when you figure that out?
It's so profound. It's so easy to say, harder to do. I have them, showing my weaknesses, and I've been doing that a lot lately. What did I get wrong, and not focusing on what I get right? That's not as important. What did I get wrong? What does it mean? I've been early on gold. You can say I'm wrong. It does have that nice pattern, and I do think it's going to be one of those things that has to create the most frustration, go up. But I appreciate that we mentioned that before we went live, and that is, it's so important in a space like, when I talk to crypto people, it's so important for them to speak to people who are not bullish and not long and benefiting from being long and bullish cryptos. And because you get that bias, and gold's the same way. I've been dealing with gold for decades, and you have to be careful of the gold bugs, always looking for things and reason for it to go up. And I look at myself, the key thing I love about being in Bloomberg Intelligence, Thomas, I'm completely neutral. They're my views. And I don't have a tap on the shoulder from a manager saying, oh yeah, Mike, we're selling a gold product. You got to be bullish gold and you can't be bearish stocks. There's so much of that you're going to hear and see. It's my views. I get edited, and that's why you see me working a little bit of editor. I'll do that after we speak. And my view is typically showing out the facts and the focus of gold. Here's one thing I want to point out about gold. The price this year at 1933. I love that price. It's such the significant year that marked the bottom for U.S. deflation in the recession, and everything, because we just devalued the currency versus gold when FDR went off the gold standard. Or, I shouldn't say off the standard, but devalued the currency versus gold. The average price here is 1933. That's the highest priced annual price ever. Okay, it's pulling back a little bit. It's running around 1900 as we speak. That makes sense as we start to hit stops and everything other markets. But you can't say that. I'd like to any other major asset can say it's the highest price ever as we tilt towards recession. I don't think so. Now that's dollars. In yuan and yen, it's all-time highs. It's just, that's what gold does. It's, and no other commodity can really say that. And it's what it's supposed to do. And even versus cryptos, the crypto people don't like when I really point this out, but it's been enduring. I think it's going to continue. And there's certain times when the store of value really has value, and that's in we tilt towards global recessions, deflationary recessions. It's happening in Europe. China, I think, is just a matter of time, and U.S. is a matter of time. So we get a typical deflationary recession. We get a pivot from the Fed, a pivot from most central banks. Stock markets underperform. Just having the asset that doesn't go down, it's doing great. But I do think gold is underpriced versus the stock market, and it's going to $3,000 an ounce. Now, other currencies I don't know, but here's one key thing that's different. I'll end with this: is there has been significant outflows from investors this year, almost 10% from if you look at total holdings of ETFs in ounces, not dollars, because the dollars distorted in ounces. That has basically never happened, Tom, and I think there's good reason for this divergence. Now, people are still having other places to go. They can clunk down their money with the U.S. Treasury and get 10% in 2 years. The stock market's been great. But what's been significant is the deepest pockets on the planet have been buying. You probably all know this. Central banks. Does that stop? Probably not. Why? Because the war started. Remember, we have a war going on, and people call it the what's been happening with the dollar, but weaponization. The war. That's a word I was trying to grab there. It's don't fade the deep pockets. They can print money and buy gold. They are not buying silver that I know of, or copper, or stocks. So of course, the Bank of Japan still buys stocks, I think. Let's not digress too much. But that's the way I see it. And again, I'm neutral. I've only been bullish gold. And also I will point out if you compare gold's performance versus any other commodity, any other broad commodity, agriculture, everything, it outperforms over time.
Mm-hmm. Yeah, of course. I mean, we've talked about all these different points, but it's interesting how you put it all together there, Mike. And interestingly enough as well, I've mentioned this book a couple times. This is maybe one for you. There's a book called The Art of Thinking Clearly. And in it, the author teaches about the idea of analyzing the things you got right just as importantly as the things you got wrong, because you want to figure out if you got lucky or if you did your analysis correctly. So I think that's a different yet interesting way of looking at it as well.
Well, Tom, I need to pay you back for that one at some point. I will. I just picked it up. I'll probably try and get it Audible if I can or something, at least try to play with it. I really appreciate it. It's also something that I think I can learn from, but I hope I can teach a little bit, because it's also, when you're running your own money, it's so important, but it's easier for me to say I'm wrong. It's a lesson I learned in the trading pits. I started in Chicago Board of Trade in 1988, is you put on a position, you define your risk and your potential reward, and you have to define your stops. Mm-hmm. And it's one thing I tried to write recently. I had a headline, "What I Got Wrong." And what does that mean and why? So that's a lesson I learned in the trading pits that was priceless. That was really more for shorter term trades, but always be able to define your stop, reassess, and move on. It's so easy to say.
Absolutely. Yeah. And I appreciate getting to chat with you a little bit about, the way you think about these lessons you've learned. Just a couple more questions left for you, Mike, here. Do you think that with the advent of cryptocurrencies, that they diverted some of the liquidity away from the gold sector over the past years?
Oh, without a doubt. I mean, it's your average 30-year-old doesn't care about gold. That's boomer rocks. Have you heard that term? I'm sure you have. I published that on the terminal a few months ago, and the editors pushed back. They had never heard it. And I'm like, oh gosh, I'm too deep into crypto. So I had to get away, because it's like they say that every day. So I love it. But it's without a doubt. I mean, my eldest son is 30 years old. So he's the one who told me about Bitcoin 10 years ago. He started mining it in college. He lost his laptop, but oh well. Absolutely. But that's reverting a little. This is why I think crypto people are going to learn a little bit. This is part of the biggest pump in liquidity ever reflected in cryptos. I mean, from 0 to 3 trillion rapidly. It's unprecedented, back down to near $1 trillion right now. But one thing people need to remember about is this money is going to the dollar and US treasuries, and some of it to gold, the diversification. I can show you the numbers. I mean, crypto dollars. The crypto dollars are created from treasuries. They're using the technology superior, and a lot of it's being parked in crypto dollars. But the key thing is to remember is when markets go down in recessions, a lesson I learned from my former hedge fund manager, Sammer, if you're listening, this is for you, is markets can take money from everybody. Cryptos, Bitcoin is basically a 50 to 60 vol asset. Those markets typically don't go up unless they're directly inverse delta to the stock market. They typically, you hit a 50 vol asset, you hit a 20 vol asset, what gold does when stock market goes down. So that's what I think they're facing. There's 30,000 of them, maybe 100 matter, massive speculation, one of the best indications of, I call them speculative digital assets. And then there's a few that matter. Now, Bitcoin to me is digital gold in a world going that way. But it is, when it started trading the dollar in 2011, it's up 26,000 times. Best performing asset in history. And I like to point out, if I'm right, the stock market's going to 3,000, which I think I will be, then Bitcoin's going to go down. And at some point it's going to bottom, and I think it's going to trade more like gold and treasuries, but it's far from that. And I think gold will be the better performer initially. Again, but the key thing to remember about crypto is most of them are speculative digital assets, and there's digital gold, it's Bitcoin. It's a nascent baby in the world, and gold is much more of a mature asset.
Mm-hmm. Mike, do you think that with several dramatic cycles now in the crypto markets and let's say the length of this crypto winter, that consumers are starting to shy away and really learn the lessons of those very speculative assets?
Not enough yet, based on price. They are. I mean, FTX was a problem. I think we're seeing problems with Binance. Might have had similar inklings. There's just, when you have money that's free and you can't get caught when you do things until later. I mean, people are going to do what people do. I mean, I'm surprised when I see some relatively respectable people kind of hint to me they're not going to pay taxes on their. I mean, why wouldn't you take that risk and don't mess with the IRS in this country? But that's just being a son and an accountant and a former accountant. But I think the key point to remember from cryptos is the technology is phenomenal and overwhelming. Cy Sheffield from Visa pointed it out, is they are now doing a lot of settlement of dollars in stable coins. I call them crypto dollars. The technology is priceless. I mean, typically it would take you 2 days to settle, and you can only do it 4 days a week with a bank because they're not always open every day, 5 business days a week. With crypto dollars, you do it instantly for nothing. Mm-hmm. Yeah, technology is early. Yes, there's hacks, but come on, remember the BlackBerry when, 15 years ago? Look what we have now. It's just, remember the internet, 92? It's just a matter of time. The technology is overwhelming, but the key thing, remember, is also for your average person in the world, in India now, you can get a phone for $12, I understand. You can get access to the wealth of knowledge and be able to buy, hold, sell, or trade crypto dollars, cryptocurrencies. And key thing I like to end with is from a trading aspect and a leading indicator aspect, there's nothing that compares to Bitcoin on a 24/7 global leading indicator basis. Yes, it's my view, but it's a very good leading indicator, partly because it's the liquidity. It shows the whole world, and everybody in the world now almost everybody's getting it fast, can access it and trade it and actually be able to take some of their melting currencies and buy something that will probably be there for them in the future. And a lot of that means just being able to get access to the dollar.
Mm-hmm. Well, Mike, I really appreciate your neutrality and the fact that you shared all of this knowledge with us today. I really appreciate this excellent conversation. Is there anything that you'd like to add before we wrap up?
Tom, thank you for having me. I've enjoyed it. I think you have better hair than I do. And one thing I like to point out is I do love to work with the Miami-Dade college students here, being selfish, just being able to work with the young people and it's so self-fulfilling. But key thing when I start presentations with them, I always like to say, never forget where you're from. And that's the key thing markets will remember the hard way, I think, is the stock market is just historically very expensive, and it's going to have some mean reversion. Is a question of what makes it and how long it takes. As Jesse Livermore says, markets will always do what they should, just a matter of time.
Mm-hmm. Excellent. Mike, of course, you're available on Twitter at Mike McGlone, MCGLONE 11, and Mike McGlone on LinkedIn as well, right?
Yes, Michael Malone at Bloomberg, just Bloomberg and LinkedIn. I'm happy to put people on my distribution list. Just send me a DM or a message on LinkedIn and your email address, and I'll do that. And looking forward to the next time we speak, Tom. And thank you for having me.
Oh, thank you for your time, Mike, and I look forward to the next time as well. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.